Ladies and gentlemen, welcome and good afternoon. This is 4ST441 Statistical Methods and Capital Markets, our second seminar. My name is Šimpach, and I think that we can start. So we will talk about financial time series, and I will say to you, what is it? Financial time series. We are talking about chronological sorted values of particular indicator in time from the past to present. Yes, you can imagine any financial time series, historical values, yes, from past to present, sorted in time t, where t is from observation 1 to capital T. Yes. Financial time series, indicator is from financial area, so we will speak mainly about stock price, stock returns, etc. Yes. There is very simple division, yes, of time series on long term and short term. Maybe in economic subjects, yes, you talked about long term and short term time series. Long term are over 1 year, yes, and up to 1 year we are talking about short term time series. Frequency of the data is usually annual, quarterly, monthly, daily. I think that I already talked about this on the previous seminar. Yes, in this subject 4ST441, we will very often use daily data, daily, for example, in working days. So 5 observation per week, because we mostly analyze stock prices and stock returns, or different types of prices. Yes, we will analyze high frequency daily data. Yes, high frequency daily data. Okay, it's very important to speak about non-stationarity of prices. Time series of stock prices are non-stationary, which is often not desirable from the statistical point of view. We'll start with time series of returns, which are closer to being stationary and are more appropriate for building statistical models. Moreover, returns provide a scale-free description of the investment characteristics. It's very important to say now that stock prices are non-stationary. What is it? You can imagine the development of any time series, and we are 3 options. Yes, how to estimate or how to say about the time series if this is non-stationary and stationary. I don't know if I have here some definition of stationarity. For example, here, yes, stationary time series most often oscillates around a steady conditional mean. Steady conditional mean. Are you able to imagine oscillating time series about around some conditional average, conditional mean? It's not important to be 0, this mean, yes, any value, any constant, yes, any constant which is constant in time, yes. And the values of the time series oscillates around 0. This is a typically stationary time series. We are able to recognize this time series only if we check the chart, yes, only line and symbol chart. Non-stationary time series has its own development. Yes? So stationary time series, most of it oscillates around a steady conditional mean. It has constant and finite variance in time. This is again very important. You can check, for example, this chart. Yes, there is 0, probably 0, yes, the conditional steady mean, and the values, you can see that the values oscillating up and down around this mean, and the variance of this oscillation is or seems to be constant, yes, and finite, constant and finite in time, yes. Okay, it doesn't mean that the series does not change over time, just that the way it changed does not itself change over time. Okay, so stationary time series. Non-stationary time series has long-term development or long-term tendency. It increases, decreases, also has cycles. Yeah, so non-stationary time series goes, yes, development. For example, in increasing trend, decreasing trend, you can see macroeconomic cycles, yes, in this time series, etc. So you can see, for example, this chart, non-stationary time series, that you can see that there is long-term decreasing development, yes, slightly decreasing development. There is, for example, some crisis where development decreased fastly and after start to increase. Yes? So there is not present some conditional mean, conditional average, yes, around it. These values oscillates. Yeah? So this is one option how to speak and check about stationarity and non-stationarity. If you check the chart, yes. Other option is autocorrelation function, and the third and the most important evaluation is to use exact tests, exact statistical tests, and we'll speak about augmented Dickey-Fuller tests. Yes, 3 types of models. Yes, and sophisticated method for testing of stationarity and non-stationarity. So let's have a time series of the prices and test whether it is stationary or non-stationary. So it will be good to show to you these sophisticated tests in EBU software. Okay, so for exact testing of non-stationarity, we are using the augmented Dickey-Fuller tests. Yes, augmented Dickey-Fuller tests, and it's necessary to write here 3 models: Model A, Model B, and Model C. Okay, so I will write the first type of model. There is variable x in time t equal to parameter phi a x in time t minus 1 plus there is summation where e is from 1 to t minus 1, parameter beta e delta x in time t minus e plus epsilon in time t. This summation, yes, is a special system of parameters and values of a variable x in time t minus e, but in differences, yes, differenced values. This system is placed to our model automatically, based, for example, on information criteria and Darwin-Watson statistics, because the residuals in these models are very often autocorrelated. Yeah? So this is automatic system for because we don't need autocorrelation in the model. Yes. So this first type of model can be called model without constant and trend. Model without constant and deterministic trend. I will write a second model x in time t. This is equal to constant for model b plus parameter phi b x in time t minus 1 plus there will be again this same system for elimination of autocorrelation. Yes? So summation where e is from 1 to t minus 1 beta e delta x in time t minus e plus epsilon t. So I will again write this to the square, and again this is the automatic system of parameters and different values of variable x because of elimination of autocorrelation. This model is called model with constant. Yes, model with C, model with constant. And finally, the third and last one, x in time t is equal to constant for the C model plus gamma c times t plus parameter phi for model C x in time t minus 1 plus again this automatic system for elimination of autocorrelation, summation where e is from 1 to t minus 1 beta e delta x t minus e plus epsilon t. Okay, so this automatic system, because the residual components, in these models are very often autocorrelated. So this is model with constant and deterministic trend. Yes, okay, so three types of model, and for us is the most important this first part, and this first part. Yes, our attention, yes, must be paid on the constants and trend if this is statistically significant, because we must evaluate these models and we must select the best one according to statistical testing. Yes, and after, very important are these parameters. Yes, phi a, phi b, and phi c. Zero hypothesis, H0 claims that parameter phi e is equal to 1, and alternative hypothesis H1 claims that phi e is smaller than 1. So what is it? Zero hypothesis. Zero hypothesis means that time series has a unit root. Time series has a unit root, and this is non-stationarity. Non-stationarity. Alternative hypothesis is stationarity. Yes. So non-stationarity, zero hypothesis. If you reject the zero hypothesis at 5% significance level, 0.05, it's stationary. We are using classical t-test, and t is equal to, there is estimate of parameter phi e minus 1 divided by standard deviation of phi e estimate. Yes, this has student t distribution, but Mr. Dickey and Fuller estimated a little bit different quantiles of this t distribution. But in eViews, software, yes, this is programmed in different way. Okay, so in eViews software we have again model A, model B, and model C. Yes, but in eViews these models are programmed in differences. Difference delta of xt is equal to, and there is 1 minus parameter phi a times x in time t minus 1 plus, and there is the summation and something. Yes, this is the system of locked values and special parameters plus epsilon in time t. So this is the first model without constant and deterministic trend. The second model, delta xt is equal to constant for model B plus 1 minus phi b x in time t minus 1 plus, and again this system, yes, summation of something plus epsilon t. And finally the third model, delta xt is equal to constant for model C plus gamma c times t plus 1 minus parameter phi c times xt minus 1 plus again this summation with some parameters and locked values of this variable xt plus epsilon t. Okay, so what is important now? So in this model A, model B, and model C, you can see these parentheses, yes? 1 minus phi A, 1 minus phi B, and 1 minus phi C. And we can denote these parentheses like rho A, like rho B, and rho C. Yes, and this will be independent coefficients, yes, in eViews software. And we have denoted zero hypothesis, where we can write parameter or coefficient rho e is equal to 0, and this means non-stationarity, yes, non-stationarity. So this is zero hypothesis. alternative hypothesis H1 is that rho E is smaller than 0, and this is stationarity. Yes, this is stationarity. So we have only these two options. Either coefficient rho, parameter rho, is equal to 0, or we can say that coefficient rho is not statistically significant, or rho is negative. There is no option to have a positive value of rho in eViews software. Yes, and finally, it's necessary to write the test criterion, test statistic. Test statistic is T. T is equal to estimate of rho E divided by standard deviation of rho E estimate. This t-test, t-statistic, has distribution T, or we can write distribution Dickey-Fuller quantiles. They are a little bit slightly different than classical T quantiles. Okay, so this is a testing in eViews. And we will see the illustrative example. Okay, so this is eViews software, and I opened for you the project, the fork file, where you can find the close price, and this is the close price of stock prices of Microsoft. Yes, we already talked about this time series. You remember that I had to set these observations, 248 observations on the beginning of 2nd January 2020, and I set 5 days working week. Yes, if you check the setting here, I can double click on 248 observations, and you can see that I have here work file structure, dated regular frequency. Frequency is daily, 5-day week, yes, and this is the months, as the first number, this is the day, and this is the year in eViews software, yes. So this is the settings. There I have close price. You can check spreadsheet. Yes, this is the spreadsheet of our values, and I can show to you the chart. You already seen this chart there. View, graph, and we will use line and symbol. Okay. So this is the development of these prices. In our situation, close prices in time t. Yes, so you can see that there is a development. For example, from June, 6 months, June or July, 6th, 7th months, where you can see some oscillation around the value for 4,800, yes, but in front of this development you can see significant increasing of close prices, yes, and there you can see large variability of data at the beginning. So I will show to you the exact Dickey-Fuller tests, augmented Dickey-Fuller tests, which are programmed in eViews software. So it's possible to click on View button, and you can find here unit root test. Yes, unit root test. So please select this unit root test, and you can see that we have here selection I don't know which version of eViews you have. I have old version eViews 8, yes, at home. So I have here only augmented Dickey-Fuller, based on general least squares, Phillips-Perron, Kwiatkowski, Phillips, Schmidt and Shin, and other Elliott-Rodenberg stop point optimal. Yes, there are other tests for unit roots because we have new version of softwares, so we'll use this old one, Augmented Dickey-Fuller, which is very easy for understanding. I already wrote for you the formulas, yes, of these tests, and zero and alternative hypothesis and test criteria. Zero hypothesis is non-stationarity, so we will select this type of test, and you can see that we have here options: include in test equation, intercept, trend intercept, and known. So there you can find our three types of model: model B, model C, and model A. Yes, known, model without constant and deterministic trend. Intercept, model model B, yes, and trend and intercept, model C. So, what's important for us? We must use all three types of model and find the best one in a statistical way. We will select the best one, the best model in a statistical way, yes, and according to information from this best model, we will decide. Yes, we will decide. Okay, so we will start. It will be good to start with model A, and model A is known, yes, model without constant and deterministic trend. So I will click on OK, and I will check what is written here. So, what's very important is to know zero hypothesis. Zero hypothesis claims that coefficient rho is equal to 0, and this means non-stationarity. No hypothesis, close price has a unit root. There we have augmented Dickey-Fuller test statistic. There is a t-test. Yes, there is the value of t statistic, which I wrote for you on the paper. So t is equal to 0.50, and we have here p value. P value 0.8238. Zero hypothesis claimed that time series is non-stationary. Time series has a unit root. So according to this information, we could decide that zero hypothesis is not rejected at the 5% level of significance. It means that the time series as a unit root is non-stationary. But we must evaluate this model, yes? In this table, there are two very important information. The first one is here, and the second one is here on the bottom. Variable close price in time t-1, and you can see here dependent variable d close price, difference delta of xt. Delta of xt is equal to parameter 1 minus phi a, yes, in parentheses 1 minus phi a. It is our rho times x in time t-1, yes, close price t-1, coefficient 0.0000, etc. and there is p-value of this coefficient. What was written in zero hypothesis? Rho, so 1 minus alpha, 1 minus phi a, 1 minus phi a, so our coefficient rho is equal to 0. This is zero hypothesis. So what means this p-value? 61%. This is the test of regression coefficient. Zero hypothesis claims that coefficient is equal to 0 at a particular level of significance. So this p-value says that this coefficient is equal to 0. Zero hypothesis is not rejected here. Coefficient is equal to 0. So both two information say the same. So there it's non-stationary. And here coefficient rho is equal to 0. So this model is statistically alright, but we must decide on the basis of the best model, best Dickey-Fuller model. So I must check the results of two other models with constant and deterministic trend. Yes, but this is alright, and according to this model, without constant and without trend, we can decide that the time series close price is non-stationary at the 5% significance level. We can continue, so please. We can click on view button. We have here unit root test. I will select intercept, yes, so model B, okay, so this is model B and P value here, as in the case of Dickey-Fuller T statistic, its value is minus 2.22, 2.22, p-value almost 20%, it means that it's higher than classical 5% significance level, 5% alpha, so zero hypothesis is not rejected. Zero hypothesis is not rejected, zero hypothesis is close price is a unit root, non-stationary, non-stationarity. But we must evaluate also this model where you can find dependent variable is delta close price, delta close price. What we have in the regression model? Constant for model B, 148. So this is the constant. And parameter phi b times close price in times t minus 1. So this is our rho, yes, rho b. And this is here, minus 0.03, but you can see this p-value 0.02. If this time series is really non-stationary, this hypothesis is not rejected, and this coefficient rho, this first one, yes, the rho is every time the first coefficient here in this regression model, and this rho must be equal to 0. What is alternative hypothesis? Alternative hypothesis is that coefficient rho is negative, yes? So we have only two options, either 0 or negative, and now we have coefficient rho negative, and according to p-value, this negative coefficient is significant, so we have here two information in the cross. So according to this, the time series is non-stationary, and according to this coefficient rho, time series is stationary. So this model is wrong, yes, because it provides two different, absolutely different information. Yes, constant C is statistically significant at the 5% significance level. It means that constant C belongs to model, but according to this information and this information, it's everything wrong because these two information, yes, are in cross, so it's not possible to use this model. And I will check the third one, view unit root test, and there is the last option, trend and intercept. So I will click on OK, and we will check the situation here. So the p-value in the situation of augmented Dickey-Fuller test statistic, yes, the t-test is minus 2.94 and zero hypothesis, time series as a unit root, is not rejected at the 5% significance level, yes, because p-value is above 5% alpha. We must evaluate this model here where dependent variable is delta close price. So we have here constant, which is statistically significant at the 5% significance level, deterministic trend, at sign trend from 2nd January 2020, deterministic trend is statistically significant. This p-value is below 5% significance level, alpha, so it means that zero hypothesis is rejected, yes? Zero hypothesis, coefficient is equal to 0, yes? No, coefficient is not equal to 0, coefficient is equal to 0.29, yes? So everything is alright, so we can check coefficient raw, the first one. Minus 0.06, 0.0689, etc. P-value is below 5%. What it means? It means that this coefficient is statistically significant. And coefficient is negative. It means alternative hypothesis, H1. So again, we have here difference between this statement and this statement. So two different information, and this model is again wrong. Yes. So we have only one good model, yes, and this good model is the first one, model without constant and without deterministic trend. And according this model, we can say that the time series close price, yes, these stock prices are non-stationary, yes, non-stationary time series. We can speak about simple gross returns now. What is it, simple gross return? Return is the change in price of stock over time. It may be represented in terms of price changed or percentage change. We can calculate the relative number, yes, either relative number, so number which can be equal to 1, no change, yes, or below 1, decreasing, above 1, increasing, yes, and this decreasing and increasing can be interpreted in percent, yes. One period, simple gross return, can be calculated like GT, gross return in time t, calculated like price in time t divided by price in time t minus 1, where p is the price. Yeah? So this is our classical coefficient of growth. Yes, coefficient of increasing, decreasing, which we calculated on the previous seminar, or which I showed to you, yes, in the previous seminar. Then K period simple gross return can be written like GT, gross return in time t, for K period, calculated like ratio price in time t divided by price in time t minus K. Yeah, so this K is variable. We can write that GT, gross return in time t, for K period, can be calculated like multiplication, as multiplication of GT minus 1, GT minus 2 times GT minus K plus 1. Yeah, so this is the general formula. Frequency of returns. Complete description of a gross return is given when also the period over which it was calculated is given. Yes. So, for example, if we have daily time series, then one period returns are called daily returns. Also, weekly, monthly, or annual returns can be defined. Yes, but if you see my previous time series, which I showed to you about Microsoft stock prices, you could see daily, as daily time series, 5-day working week. Also, high frequency returns can be calculated using high frequency data. We can have more observation per one day, for example. Yes, for example, hourly, yes, published data. Okay, simple exercise 1. Given the artificial daily, in our situation, data below, replace the question marks with one period simple gross returns. You can use calculator or Excel, and we would like to interpret the result. So I have here calculator. There is written that we have here a table with artificial data. There is T from 1 to 5. It means, for example, Monday, Tuesday, Wednesday, Thursday, Friday, 5 working days. Price in time t, price on Monday, price on Friday, and we would like to calculate one period simple gross returns. So what is it? It's a simple ratio, price in time t and price in time t minus 1. So if I use calculator and right here 117 divided by 114, result is 1.026. So increasing by 2.6%. If I use 115 divided by 117, result is 0.983, so it's decreasing by 1.7%. As etc. 102 divided by 115, result is 0.887. 0.887, so it's decreasing by 11.3%, I hope, yes, and 121 divided by 102, result 1.186, so increasing by 18.6%, yes. So we have available Microsoft Excel, so we can check this example here. You can see that there is T from 1 to 5 prices, yes, and one period simple gross return I have calculated here. So what I said to you, I hope that it was good. Correctly, you can see this ratio, yes, value, price on the position 2 divided by value, the price, yes, on the position 1. We had to start here because we don't have 0 observation, yes, we lost 1 observation here. Okay, so then we have the results. relative numbers, yes, what is below 1 is decreasing, what is above 1 is increasing. I had to think about interpretation here because the result was 0.887, yes, if you remember, and the interpretation was decreasing by 11.3%. So I calculate it well, yes. I will not give you this Excel, it's my Excel, it's only for my personal calculation, but I showed it to you. You can create this data sheet at home if you want, yes, and calculate it as well. That's all, and we can move simple exercise to calculate the geometric mean of the one period simple gross returns. Why geometrical mean? We had here relative numbers, indices, yes, the values equal to 1 or below 1 or above 1, yes, indices. And if you want to calculate the mean from indices, from relative numbers, yes, it's necessary to use geometrical mean. Okay, so the geometrical mean, x with stripe g, yes, like a mean, geometrical mean, is equal to, and there is n minus 1th root from multiplication g2, g3, g4, g5. What is important? We have 5 working days, yes, in our data set. N is equal to 5 working days. 5 minus 1 is 4, and below this root is multiplication of 4 values only, because we had to omit it one value because we didn't have observation 0, yes, we have only 4 gross returns, calculated gross returns. Okay, so this is the formula. After, what is the corresponding return on the annual scale? This is the question. After, we will calculate G54, yes, where T, the time, is equal to 5 days, and K, the period, is equal to 4. And we will verify that G54 is equal to multiplication of these 4 gross returns, G2, G3, G4 and G5. Yes? So it will be good to return back to our Excel, and the calculation is here. 4 period gross return, 4 period K, the period is equal to 4. The calculation G5, 4 in squared parenthesis, is calculated, is equal to price in time t divided by price in time t minus k. In our situation we know that time is 5 and the period is 4. So price on Friday divided by price in time 5 minus 4, so result will be 1. So price on Friday divided by price on Monday. It should be 121 divided by 114, because 121 is price on Friday and 114 is price on Monday. And result, the ratio of these two values is equal to 1.061. Again, relative number above 1, it means increasing by 6.1%. And if you check the calculation of multiplication, yes, of these four values. This C8 is this green cell here, so multiplication 1.026 times 0.983 times 0.887 times, and there is the last value 1.186, yes, and the result is here, and it's the same. So we verified that it's the same. Okay, so I verified this, but I forgot to calculate the geometrical mean. So I need to calculate the multiplication of four gross returns, and after I will calculate the fourth root, yes. So we can move back to Microsoft Excel, and one period simple gross returns I have here. So I will use the calculator only, and I will multiply 1.026 and 0.983 and 0.887 and 1.186. The result of this multiplication is 1.061. Yes, 1.061. Okay, so now I will use power function, yes, the hat, and I will power this by 1 divided by 4, yes, because I need to calculate the square, the fourth root. 1 divided by 4, power function, powered by 1 divided by 4, and the result is 1.015. 1.015. So it's geometrical mean, geometrical average 1.5%. Yes, 1.5% is average increase. So we can move back to presentation, and we can continue with simple net return. Simple net return, one period simple net return is calculated like RT, again return in time T, is calculated like the ratio price in time T and price in time T minus 1, so again two neighborhood values, yes, minus 1. So it's possible to calculate like price in time T minus price in time T minus 1 divided by price in time T minus 1, and there is written that price PT is the price. And again, K period simple net return can be denoted like this: R in time T for the period K, calculated like price in time T divided by price in time T minus K, and this all minus 1. Yes, and this calculation is the same like this calculation, but instead of 1 we have K period. This simple net return, it's very easy to see that net return can be calculated like gross return in time T minus 1. If you remember my Excel, yes, I already interpret for you this net return as increasing, decreasing by X%, because from the relative number gross return in time T, I calculated this gross return minus 1. Yes, I decreased this value by 1, and I interpret this result. Net return in time T for the period K is calculated like gross return in time T for the period K minus 1. So this and this the same practically. And in general, yes, we can write that net return in time T for the period K yes, is equal to, in parentheses, we have 1 plus net return in time t times, another parenthesis, 1 plus net return in time t minus 1, yes, times, in other parenthesis, 1 plus net return in time t minus 2, yes, times, in other parentheses, etc., etc., and at the end we can see 1 plus net return in time t minus k plus 1, yes, and that's all minus 1, because there, everywhere is multiplication, yes, and multiplication has bigger priority than minus 1, yes, so the minus 1 is the last one. Okay, exercise 3, given the data below, replace the question marks with one period simple net returns, and we'd like to interpret the results. We'll calculate net return in time 5 for the period 4, and we will verify that net return in time 5 for the period 4 is equal to, and there you can see 1 plus net return in time 5 times 1 plus net return in time 4 times, etc. All these multiplication, 1, 2, 3, 4, yes, 1, 2, 3, 4 multiplications minus 1 is the same like net return in time t for the period 4. You can see that there is our well-known table with prices, yes, from Monday to Friday. Gross returns we have already calculated here, and we'll calculate one period simple net returns. Okay, so you can see I already interpret this for you. Gross return minus 1, it's interpretation, yes. If you multiply these values by 100, yes, it's possible to interpret it in percent, increasing by 2.6%, decreasing by 1.7%, decreasing by 11.3%, and finally increasing, yes, between Thursday and Friday, yes, it increased by 18.6%. And there you can see the multiplication of these four values. We'll check these values. You can see there is one period simple net return on Tuesday, return on Wednesday, return on Thursday, and return of Friday. Yes, everything plus 1. Yes, you can see return plus 1. Okay, so there is a multiplication of these returns increased by 1. Yes, and minus 1. Okay, so we calculated net return, yes, and the time equal to 5 and the period equal to 4 according to this formula. And now k period simple net return, yes, we will use this formula r in time t with the period k is equal to price in time t divided by price in time t minus k, and this all minus 1. In general, it can be expressed by this formula. So we can return to Microsoft Excel, and there we have written 4 period net return, yes, with k equal to 4. And the formula, yes, which you could see on the slide before, R5 net return in time 5 for period 4 is equal to price in time t divided by price in time t minus k, this all minus 1. So t is equal to 5, period is equal to 4, so it's price in time 5 divided by price in time 1. 5 minus 4 is equal to 1, and this all minus 1. So if you remember, price on Friday was equal to 121, price on Monday was equal to 114, so 121 divided by 114 is 1.061, minus 1 is 0.061. So the verification was successful. We will continue with small exercise 4. You bought 10 shares of a company at price P1 equal to 50 per share and held the position for 10 trading days and sold the shares at price P11. The corresponding 10 period simple net return was R11, net return T equal to 11 with period K equal to 10, and this is equal to minus 0.2. What was the value of your 10 shares at the moment you sold them? So again we have here Excel. I calculated this for me, so if you want to verify my calculation, you can create this Excel at home. So you can see this table, yes? N is equal to 10 shares, the sample size, yes? The size of your shares is equal to 10, price on the first day, yes, first day, 50 units, I don't know, dollars, euros, Czech crowns per share, yes. The period K is equal to 10 days, and the price on 11th day, yes, is unknown. So you can see that there is a table starting on T equal to 1. There is nothing, yes, the price is known, and the period K is equal to 10, yes. And there should be the price in time T equal to 11, but it's not here. We know the net return R in time 11 with the period K equal to 10, yes? It's minus 0.2, yes? We know this. And we know how to calculate the gross return. If we know net return, yes, we know how to calculate gross return in time 11, yes, with the period 10. Net return plus 1, yes? So minus 0.2 plus 1 is 0.8. And after, for illustration, we can use these formulas. Gross return, yes? This gross return, this ratio, 0.8, yes? Gross return in time 11 for period K is calculated like price in time T divided by price in time T minus K. So our T is 11, price is price in time 11, which is unknown, divided by price in time T minus K, 11 minus 10, 1. We know price in time 1, yes? It's the first value in our table. And we know this ratio, 0.8. So price in time 11 is calculated like this gross return, 0.8 times the first price in our statistical sample, 0.8 times 50. So the last price, the price in time 11, is equal to 40. originally we had 10 stocks, yes, 10 pieces of stocks. Okay, so original value of stocks, n times price on the first observation, yes. We had 10 stocks times 50, 10 times 50 is equal to 500. Value of stocks after 10 days is n times price on 11th day, yes. So n is still the same, 10 times 40 is 400. So this is the final result. We will also speak about the logarithms of returns, yes, log returns. I showed to you I already showed to you some time series with different development and a lot of prices, time series of different prices have logarithmic log normal distribution, and the modeling of the time series with logarithmic normal distribution of the data is difficult because we required, for example, normal distribution of the residual component. And if the variable which you would like to explain, the dependent variable, yes, our dependent variable, is not normal at the beginning, it's very difficult to have normal residual components. So, very often the prices are modeled, yes, in software in logarithms. So this is the reason why we'll speak about these logarithms here. You will see that it's not difficult, it's just a transformation, yes, like I already showed to you, transformation, the original values to the natural logarithms. One period log return is defined as RT, now will be small r in time t, like logarithms. This is in Czech Republic convention, yes, LN. In British and American English, yes, is log, but in Czech language log is a decadical logarithm with base 10, yes. This is natural logarithm with the base of Euler constant, Euler number 2.71, etc. Yes? So natural logarithm of gross returns is equal to logarithm from ratio price in time t and price in time t minus 1. Yes? PT is price, GT is one period simple gross returns. K period log return is defined as R in time t, and the period K is equal to natural logarithm of gross return in time t for the period K. This is equal to logarithm, natural logarithm from the ratio of price in time t and price in time t minus k. It's easy to see that logarithm of return for time t and the period k is equal to simple summation, yeah? Simple summation of RT, small r in time t, plus r in time t minus 1 and r in time t minus 2, t minus 3, etc. And finally we'll finish with log return in time t minus k plus 1. We will continue with exercise 5. Given the data below, replace the question marks with one period log returns, and we will interpret the results. We will also calculate log return in time t equal to 5 and the period k equal to 4, and we will verify that log return for time 5 and period 4 is equal to summation of log return for Friday and log return for Thursday, log return for Wednesday, and log return for Tuesday. Okay, so one period log return for time t is logarithm ln from the ratio price on Tuesday and price on Monday. Yes. Again, logarithm of return for Wednesday is calculated like the ratio. Yes, logarithm from ratio of price Wednesday and on Tuesday, etc., etc. So you can see we have here four values: 0.026 minus 0.017 minus 0.120 and 0.171. So we calculated these log returns, and there is calculated a column, yes, a column with only natural logarithms of one period simple gross returns g in time t. So there we have 1, 2, 3, 4, the value for Tuesday, Wednesday, Thursday and Friday, simple gross returns, yes, these relative numbers, and in the final column, as the last column, you can find calculated the logarithms of these gross returns. You can see the results are the same. Let's calculate R5 with the period for return. For example, again here in Excel. So for period log return with k equal to 4, yes, will be calculated according to this formula. Log return for time 5 and period 4 is calculated like natural logarithm from the ratio price in time t and price in time t minus k. We know that t is 5 and k is 4, so natural logarithm from this ratio price on Friday and price on Monday. 5 minus 4 is again 1, so it will be natural logarithm from the ratio 121 and 114, and this result is, you can see, logarithm from this ratio 0.060. And there, next to this cell, is calculated natural logarithm from this value 1.061, and this is gross return for the time 5, Friday, with the period 4. So you can see that the results are the same. We can also verify that log return for time 5 and period 4 is equal to summation of these 4 log returns. Log return for Friday, Thursday, Wednesday and Tuesday. So you can check here in this column one period log return. There I have calculated 4 values. 0.026 minus 0.017 minus 0.120 and 0.171. The summation of these 4 values is 0.060. So you can see that all 3 results are the same, are equal. Okay, so we can continue in our presentation. Interpretation of logarithms. Yes, I showed you only the results, but without interpretation. If a simple net return RT, capital R in time t, is close to 0, the respective log return, small rt, can be approximately interpreted as the simple net return. A simple net return, capital RT, can be interpreted as a percentage change of the price when multiplied by 100. Yes, it's possible to multiply by 100. I already interpreted this by 100 and talked about this, yes, in percentage. Therefore, log return, small rt, can be approximately interpreted as a percentage change of the price. Log returns are often the most preferred type of returns, as the log returns. Logarithms of the ratio, yes, which you could see in the previous slide. Log returns are often the most preferred type of returns in modeling financial time series. The reason for this will be made clearer next weeks. Yes, I a little bit talk about this in the situation of the distribution. Yes, the distribution of the values in analyzed time series. Yes, most prices are logarithmic normal distribution, and it's difficult to model logarithmic normal distribution time series because of the characteristic of residual component. But about the main characteristics of the residual component we will talk later, so we'll speak about this also later. Another exercise. A one period log return is equal to 0.1 log return. Yes, one period log return, so small r. What is the corresponding one period simple net return and the corresponding one period simple gross return? So again, it will be good to back to Microsoft Excel, and I will show to you the steps. Yes. One period log return 0.1. So r in time t, small r in time t, 0.1 log return. We don't know, yes, simple net return and simple gross return. So capital R and capital G. We know these formulas, yes, from our presentation, that log return in time t is calculated like logarithm of gross return in time t, so it can be expressed like a logarithm of this ratio, yes, price in time t and price from previous observation, price in time t minus 1. Gross return can be calculated like exponent of log return in time t. Yes, so you can see here exponent. Yes, Euler constant powered by this number. Yes, what is it? Euler constant, the base of the natural logarithm, 2.71, 71, etc. So this Euler constant exponent, 1 in parenthesis, exponent powered by 1, exponent powered by 1, 2.71828, etc. So the base of the natural logarithm powered by 0.1. Result is 1.105. Yeah? So this is gross return. According to our formulas, we can calculate net return, RT, like gross return minus 1. So this net return is 0.105. Yes. it can be interpreted like a percentage change in price, yes? So if we use gross return or net return, we can see that this is above 1 and this is above 0, so increasing percentage change, increasing by 10.5%. Yes, it's possible to multiply this value by 100. 0.105 times 100 is 10.5% percentage change in the development of prices, so increasing by 10.5%. So, the properties, the characteristics of logarithms, heavy tails will be discussed in more details, mainly in the next weeks. What is it, heavy tails? Probably you could see before the distribution of gross wages, the salaries, yes? The salaries, it's not the time series about stock, yes, but it's a macroeconomic indicator, average gross monthly wage, yes, but the wage, the salary, is also the price, and most prices, yes, has logarithmical normal distribution with heavy tail at the end. Yes, with heavy tail at the end. So this characteristic is typical. Weak autocorrelation. This will be also discussed in more details in next week. And time varying volatility also will be discussed in more details in next weeks. Finally, at the end of our seminar, we will do this exercise 7. We will take a real-life data series of daily stock prices, PT, of Microsoft Corporation for year 2020. So this is the same data set like I showed to you for the testing of stationarity. Yes. So from these web pages, calculate and plot the time series of daily gross returns, GT, net returns, RT, and log returns, small rt. Compare the time series, and we'll verify that RT for the period K, yes, log return for time t and period k, is equal to summation, yes, summation of these log returns in time t, t minus 1, t minus 2, t minus 3, until t minus k plus 1. So we can open one more time reviews. We can open this data set and we will do this. Okay, so at the beginning of our today's seminar, we verified that the time series close price, yes, of Microsoft Corporation is non-stationary, yes. According to Augmented Dickey-Fuller test, the first type of model, model A, without constant and without deterministic trend, as we verified that this time series is non-stationary at the 5% significance level. And now we will calculate the gross returns. We can check the chart of this time series, so we can double click on close price. There you can see the spreadsheet, there is view button, we can click here on graph and use line and symbol, okay? So this is our non-stationary time series, okay? So we can move this chart to the right, and there we have command log. So we can increase the size of the font, and we can write So we will calculate the gross returns. On the top of this screen we have the command log. So we will write here the keyword series space, and we will write here the new name of the time series. For example, gross or gross close price, it doesn't matter. Okay, so gross close price, and equal sign, and we will calculate this like close price divided by close price in parentheses minus 1, close price in parentheses minus 1. We can click enter, and you will see that there is new time series gross close price. So you can double click on this time series. You can see that there is not available the first value, yes, because we don't have the price in the period 0. And we can click on the view button, and we will check the chart, yes. Okay, line and symbol, okay. Okay, perfect. You can see that this time series on the first view look stationary. Yes, because there is something like conditional mean, conditional average. So we can move this time series on the right, and we can also calculate the net returns. Yes, the net returns, capital R, in time t. So again, below this command, we will write series net close price, and the formula is gross return minus 1. So we must write here gross close price minus 1 and enter. Yes, gross close price minus 1, enter, and you can see here net close price. So again, you can double click on this file with the data. Okay, we don't have the first observation, and you will see that this time series will oscillate around 0, because this time series oscillated around 1, and we decreased this time series by 1. So you can click on view button, graph, and okay, so we can compare these two charts. Yes, these two charts, there is value 0, there is value 1. Yes, I said that this time series seems to be stationary. Yes, and this time series also seems to be stationary, but the conditional mean will be probably 0 or very close to 0. Yes, so again, we can move this chart here, and finally we can calculate log return. Yes, log return, small r in time t, and according to our formulas, log return is calculated like nature logarithm of gross returns. So we'll use the keyword series. Log return close price will be calculated like yes, there is equal sign, log. It's British American speaking software. Yes, English speaking software. So we must write log. And in parentheses, gross close price. Yes, so you can click on enter, and you have here log return close price. So you can click on view, graph, and okay, yes, there is 0, and this chart seems to be similar. So we will try to verify this. Please close this chart and close this chart. Yes. Okay, we will compare net returns and logarithms, yes, in one chart. So there is net close price and logarithm. So we will use control button and for example like pictures in the computer, yes, we will select two files. We will use right button and we will open as group. We will open as group. You can see two columns. There is value, for example, minus 0.001377 and there is minus 0.001378. So you can see very small differences. We can compare these very small, not significant differences in one chart. So you can click on View button, there is graph, and we will use again basic type, line and symbol, OK. And if we maximize this chart, you can see logarithm close price, yes, is red one, and blue below this curve you can see net close price, net returns. You can see very small differences, mainly in the case of outliers, yes. There is, for example, one outlier, very significant peak, yes, where you can observe the difference between the red curve and the blue curve, but these differences are not significant. We can close this chart and we can also close the chart on the right side of the delete yes. Okay, we can open, for example, gross close price. Gross close price, and I said that this time series seems to be stationary. Yes. At the beginning of our today's seminar, we tried to test the stationarity of the time series. So we will do this. Please use View button, and there we have Unit Root Test. We have selected Augmented Dickey-Fuller test, and we talked about model A, model B and model C. Do you remember? So model A is known, model B is intercept, model C is trend and intercept. So we will select known, the first one, model A. We'll click on OK and we'll check what is written here. I need to see everything. Yes, this is enough. Okay, so do you remember the zero hypothesis? Zero hypothesis, time series, gross close price as a unit root is non-stationarity. Yes, non-stationarity. The result of student t-test is here, minus 0.1065. P-value is 0.646, is above 5% significance level, so the zero hypothesis is not rejected. But do you remember what is zero hypothesis? Zero hypothesis claimed that coefficient rho in the regression model is equal to 0. Yes, coefficient rho must be equal to 0. So that is our model. Yes, you can see dependent variable is delta gross close price. That is our model, and this first coefficient is your rho. That is written minus 0.000177, and p-value is 92%. What it means? It means that this coefficient is not statistically significant at the 5% significant level. It means that this coefficient is 0. So this rho is equal to 0. P-value here is about 5%. So these two information give you the same information. So it's all right. The time series is non-stationary according to these two information. But we must compare all models. Yes? This is only the first one. Yes? Can you see 1, 2, 3, 4, 5 these 5 coefficients with these differences of gross close prices in first luck, second luck, third luck, fourth luck, and 5 luck? This is the extension of the augmented Dickey-Fuller model, Dickey-Fuller test. Yes, the residual component, yes, was probably very strongly autocorrelated. So the process, the algorithm inside the software, yes, put these variables automatically to model. Yes, I selected only this first one as my phi a x in time t minus 1. Yes, this was only my option. Everything else is automatically. So now the information from here is that the time series seems to be non-stationary. I don't think so. So please click on View button and select Unit Root Test. We'll select model B intercept and we'll click on OK. And now you can see that this is a stronger model because we are using constant. Constant is statistically significant at the 5% significance level. So this model is well specified. P-value here in the case of augmented Dickey-Fuller test statistic is 0. So 0 hypothesis, non-stationarity is rejected. It's rejected. Alternative hypothesis is stationarity. And what is the form of the alternative hypothesis? Coefficient rho is negative, is smaller than 0. Coefficient here, coefficient rho, is minus 1.0966, and this coefficient is significant at the 5% significance level. So according to this model, the time series of gross close price is already stationary. So this is all right. And we must compare also the third type of model. So unit root test, trend and intercept, okay. And you can see the deterministic trend is not a part of this model because deterministic trend is not statistically significant at a 5% significance level. So we selected this type of model wrongly. There is no sense to interpret this p-value and coefficient rho. So we have only two correct models, model without constant and without deterministic trend, and model with constant. So the model with constant is a stronger one. So we'll use information from the model B, model with constant time series. View graph, okay. View graph, okay. This time series is stationary at a 5% significance level according to augmented Dickey-Fuller test. Model is constant. Okay, so this is the end for today. At home, in any software, yes, either eViews or Gretel or RStudio, etc., you can do the same with logarithms. With logarithms, because in future we'll mostly model the logarithms. Yeah? So you can train at home, and this testing, this evaluation, you can do with logarithms. So that's all for today. I hope that everything was clear. I will see you next week on our third seminar. So have a nice day and bye bye.